Good afternoon. Before we start, I'd like to thank the CFA Institute, the judges, our instructors, and our mentor. My name is Keiichi Ono. I'm here with Azaan Barlas, Sean Harper, Edgar Lucatero, and Vanessa Gonzalez, and we value Snap Inc. as the sell for a valuation of $37.74, giving it a premium of roughly 40% at the current price. Our catalysts to sell include Snap's inability to operate effectively, a competitive industry, and a management structure controlled by the co-founders, Evan Spiegel and Robert Murphy, who own over 95% of the voting rights. Our team will walk you through the process of each catalyst, starting with a brief business overview. Snap Inc. started through a simple idea to send messages that are deleted instantly. Since its inception in 2011, the platform has grown to over 265 million daily active users, or DAUs. Snapchat offers a variety of features, including Snap Map, Camera, and its new product, Spotlight, but consistently incurs substantial expenses compared to their revenues. Snap also operates in a highly competitive social media industry with reputable platforms, including Facebook, YouTube, and Instagram. Their revenues are almost entirely derived through ad revenues, with less than 1% from other business lines, highlighting a lack of product diversity and unprofitability. When looking at the price sales premium versus the industry, Snap's current premium is over 120%, revealing a strong likelihood that Snap cannot justify these lofty valuations. Nishan, can you tell us a little bit more about the catalyst?
Yes, I can, and thank you, Keiichi. Now we spend a couple minutes on Snap's revenues in the competitive environment. First, Snap operates in an extremely competitive market with well-run, highly capitalized, and technologically advanced competitors. Snap controls about 2% of the social media industry and struggles with the core components that drive revenue, including a lack of product diversity, limited monetization, failure to retain features, industry regulation, alongside prohibitive policy changes at Apple. Snap has failed to retain innovative features throughout their history. Most famously, in August 2016, Instagram launched their own version of Snap Stories and overtook Snap's DAUs within 5 months. These innovative retention issues have plagued Snap's growth potential and top-line performance. As mentioned, Apple's new features will allow users to restrict their data from third-party applications. Analysts project that Snap will be the worst affected company in the entire industry and will face around 5% revenue headwinds, which may delay their ability to reach profitability. The COVID-19 pandemic has temporarily boosted sales at Snap due to an increasing trend away from traditional marketing media to digital. On top of the COVID-19 sales boost, in July 2020, almost 400 companies pledged to stop advertising on Facebook until after the US presidential election, and Snap has been a major benefactor of this boycott. We believe a portion of this incremental revenue to be transitory as advertisers return to both traditional marketing media and Facebook. Snap ranks last against its peers in terms of comparable financial metrics such as operating margin and return on equity. Snap also fails to monetize their user base, and compared to Facebook, Snap lags in every single region. Finally, as you can see, Snap has the highest price to sales and EV to sales in the entire industry. Now, Azaan, can you provide a little more background with respect to ESG and management?
Yes, I can. Thank you, Sean. Moving on to ESG, each factor of environmental, social, and corporate governance are not equally distributed in terms of the effect on the company's business. Snap has reported to release around 144,000 metric tons of CO2 in the environment, which is actually better than Facebook's 251,000. Ultimately, though, for social media companies, CO2 emissions are insignificant. Within the social category, Snap underperforms its peer group, given a lack of diversity within the management team. Specifically, they register second to last in the peer group for minority leadership. Now, Snap's corporate governance is a major risk. The current founders of Snap, Evan Spiegel and Robert Murphy, hold over 95% of the voting rights. Management has regularly underperformed, with Snap Cash and Spectacles, two important diversification efforts, costing Snap more money than revenues earned. Snap also consistently has high turnover for both employees and executives. Notably, over 20 executives have left the company since the IPO in 2017, with the 10 most important listed here. The lack of employee retention and C-level executive attrition is a major warning sign that does not indicate a workplace culture that allows its employees to build competitive products. Now on to the meat and potatoes, the financial analysis. Snap does not generate positive free cash flows, and in fact, they never have. This lack of free cash flow generation is exacerbated by two contracts signed with Amazon and Google for web and cloud services. This chart shows that Snap still owes $1 billion and is scheduled to renew these contracts in 2022. The company also gives high stock-based compensation, or SBC, to executives and leadership, as CEO Evan Spiegel has received over $1 billion since their IPO. Although SBC doesn't directly hurt free cash flows, it does serve to dilute the stock over time. Now, Snap's capital structure breaks down into a majority equity. Snap does keep liquid with $2.5 billion in cash and equivalents, along with around $1.7 billion in debt from 2 convertible bonds. These bonds are extremely dilutive to the stock if converted, adding 100 million shares to Snap's equity. In addition, Snap's revenue monetization is concerning. Snap generates most of their revenues from North America at 70%, even though their biggest audience is the rest of world region. So, Edgar, can you tell me how all of these investment catalysts factor into the valuation?
Sure, Son. Thank you. So, in assessing Snap's intrinsic value, we decided to use both a DCF and a relative valuation. But why use two methods? First and most importantly, the DCF allows us to incorporate critical assumptions about geographic user growth and reflects our conviction with respect to how Snap monetizes active users, helping to inform top line growth. Second, we believe it's imperative to compare the young company to its peers to capture the market sentiment with the relative valuation model. Using a 3-year forward median EV to sales multiple of 4.2, we can properly assess Snap's relative value. Estimating an appropriate WACC involves making some careful assumptions. For the cost of equity, we use the capital asset pricing model. This involved finding its beta, and we did so by unlevering the median beta from Snap's peer group and then relevering it to fit Snap's capital structure. We used a proxy for cost of debt since Snap's bond yields are currently negative, simply by using the B index yield to maturities at the time of issuance. We went with the risk-free rate of 1.64, reflecting the 10-year treasury, and we expect the S&P to return 7.5%, reflecting the index's long-term annualized performance over the past 20 years. This way, we arrive at our equity risk premium of 6%. Lastly, to reflect Snap's high growth industry, we assume terminal growth at 3.5%. To support some of our assumptions, we conducted a survey with 375 participants. Analyzing this data, we made two main conclusions. First, there is low user retention. We found that 40% of respondents use the app very frequently to less often, and only about 15% of respondents use the app very often initially and still use it very often, suggesting that the app isn't very engaging to users. Second, from Snap's most engaged age group, ages 18 through 34, only 4% have ever purchased a product due to an ad, suggesting Snap isn't monetizing users very well, which could be a red flag for advertisers. So, how did we use these insights to support our growth figures? Comparing our growth figures to consensus, we can see that they believe there would be greater growth in developed segments, which assumes increases in DAUs and much better monetization. Because of our research and survey results, we believe a bulk of the revenue growth will come from rest of the world, since it is an unsaturated market, unlike the other segments. By far, our greatest difference to consensus is in the gross income margin. We don't expect to see this margin be greater than 70% over the next 5 years, given Snap's inability to control costs. This is the most impactful variable in our model, since if we replace our estimates with consensus figures, our valuation jumps nearly 20% to $45 per share. However, it would still be overvalued by about 28%. At 23.3 EV to sales, Snap is trading at a historical premium considering its average EV to sales. Additionally, we conducted a sensitivity analysis using 5 different metrics, supporting our conviction that Snap is overvalued. There are many other uncertainties with Snap, and as with any investment recommendation, there are risks associated. Vanessa, can you highlight some of these risks?
Of course, thank you, Edgar. The two risks that we find most probable and impactful are the global social media ad market growth and Snap's innovative ad experience. Here you can see that social media ad spending is expected to grow to a $120 billion market, with most of the growth happening in the mobile segment where Snap operates. And although this may seem encouraging, we do not believe that Snap will be able to capitalize on this growth since they've been struggling to expand their target demographics. Moving on, Snap allows its users to experience products using augmented reality filters. The AR market as a whole, including advertising, is expected to grow to a $30 billion industry by 2023. Yet we are not confident that Snap will be able to materially profit on this growth, given their struggles monetizing their contents. To conclude, we believe that the market has underestimated Snap's inability to operate effectively, their laggard position in a highly competitive industry, and their centralized management control. We give them a target price of $37 with approximately 40% premium. And overall, based on the reasons presented today, when it comes to the security, we would sell it in a Snap. Thank you.